What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we're talking taxes. Now, I am not a tax expert, so please make sure that you follow up with your own tax expert here. But the idea is kind of bringing you guys a little bit of insight as to basics of taxes if you're looking at investments and things of that nature. So if you were excited for today's video or just curious to learn a couple new things, hopefully about taxes, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. We're going to cover a couple things here. And again, I am not a CPA or anything of that nature here, just a couple basics that I've learned over the years here and to kind of visualize with an example towards the end about what you can possibly do to help make your taxes be a little bit better here. But again, as always, talk to a tax expert, which is not me, but just kind of bring in some couple things that are very much important. So, if you are looking at someone who's investing into stocks, into the stock market, you have what is called capital gains. Okay. So say you buy, a stock at $10 and it goes to 25, 30 bucks and you make money as a result of it, you are going to be, paying taxes on the gains that you made. Okay. So if you made 20 bucks per share, you are going to be taxed at some percentage of that $20 profit that you have made. So that is something that's very much important to keep track of and to know, because when you get your tax bills, again, we're at the tax season. We're very close to getting into the taxes for 2025. You have about a month left until those can start being filed. It is important to know where your taxes are going and how paying them actually works, because we don't want you to be hit with some random tax bill at all. So what is the difference between, we have short-term and long-term capital gain or losses? So there's also losses as well, but we'll talk about that later on. Capital gains and losses are handled according to how long you've held a particular asset, known as the holding period. Profits you made from selling assets you've held for a year or less are called short-term capital gains. So if you have made money on a stock that you have held for less than a year, say, for example, you've day traded for the year and you've made a lot of money as a result of it, those would fall under short-term capital gains. If you hold it for longer than a year, so a year and 1 day, then you would fall into the long-term capital gains. Okay. Now, there are rules and taxes are a little bit different here as a result of it, but it is important to keep in mind the difference here. Now, when we talk about short-term capital gains rates, which is what you'll be looking at for filing in 2026 for the 2025 year. Basically, your short-term capital gains follow your ordinary tax brackets on your income filing status. So if you are paying, for however you're going to get taxed up to this point, you're going to basically be following the taxable income. It's the same thing as short-term capital gains. Now, why is that the case? Well, if you made the money within a year, it basically just falls into income level. Okay, so if you held it for less than a year, you fall into that income idea because, again, your income is yearly and you pay taxes on your income every single year. Same thing with short-term capital gains, so it falls in the exact same bracket as you will see here. And again, your tax rates will depend on, on your income and your filing status, but it ranges anywhere from 10% to 37% as you know over time. So, for example, if you made over $600,000, you would have to pay 37% taxes on short-term capital gains. Okay. If you made less than $10,000, for example, so you made $10,000, you'd only pay 10% in capital gains if you were a single filing status for your taxes. Again, depending on what you file is obviously a huge factor. So you can't sit there and say, well, Fridge, I do this and I did it. Like, everybody's situation is different. But the thing to keep in mind about is if you bought shares of a company or options and you sold within a year, you are paying short-term capital gains tax, which basically follows your taxable income. So that is something to keep in mind about. Okay. So if you have a high income and you also make a lot of money on trading, for example, you're paying higher in taxes. It falls into the ordinary income idea behind it. Now, that's short term. Long term, which again, and the reason why we do long term is because, we want to, give people a little bit of a benefit for holding investments for longer than a year. Because if you're investing into companies like Apple, like Google, Meta, all these major companies in the US that are part of the S&P 500, if you're investing into our businesses in the US, into our economy, we want to say, hey, if you have your money tied up for longer, we'll give you a little bit of a benefit, as you will see here from long-term capital gains. So what you'll see here is the minute you've held a stock for longer than 1 year and you take profits on it as a result, you do not have the same tax brackets, okay? So depending on how you file, obviously makes a difference. But if you make up to $48,000 in your taxes and stuff like that, you would actually pay 0% on long-term capital gains. So you don't pay any tax on it if you held it for longer than a year, which is a lot different than over here when you do short-term capital gains. As you'll see, even if you made $10,000, you still have to pay capital gains short-term taxes up here, actually. Sorry. If you made $10,000 in your trading, for example, you're still paying short-term, within a year, you're paying short-term capital gains, which would be 10% of the whatever. But if you held it for longer than a year, you're paying nothing up to $48,000. Again, that's the huge benefit of holding stocks and trading and stuff like that and taking profits longer than a year out. If you make over $500,000, you're only paying 20% capital gains, which is a lot better than, say the 35 to 37% range of taxes here. So holding stocks for longer terms and mutual funds, ETFs, options, contracts, whatever, if you make profit after a year, you get taxed a lot less, which is a huge benefit that we talk about in the investing game. So keep that in mind as you're getting ready to do your taxes. If you bought this year and you sold this year, you made some money on like a meme stock, for example, you're paying short-term capital gains on it. So keep that in mind that those taxes will come up, especially when you file them either on TurboTax or with a CPA or whoever it is you're looking at. Make sure you know that you are claiming these as capital gains, short-term versus long-term. Know the difference. I believe your brokerage should break it down as to how much you're going to be doing it, and then you're able to just kind of input the data in from there. But keep that in mind that if you made a killing on like Open Door, on Beyond Meat, other meme stocks, I think Kohl's is a meme one for a little while, GoPro. It's made a lot of money on any of those ones. Iron's been a huge one this year, but not a meme stock. They've been a huge play this year. OKLO, all those kind of stocks that have had huge returns this year. Keep that in mind that if you bought at the beginning of this year and you sold before a year is up, then you are paying short-term capital gains tax just like ordinary income. If you hold it for longer than a year, you pay long-term capital gains, which is a lot more of a benefit. Now, things to keep in mind about is that you also have capital losses as well. And capital losses are actually beneficial because they help you offset your gains, which means you might pay a little bit less in taxes as a result. Now, obviously, we can't do every single example under the sun here, so you have to kind of do the math yourself to kind of figure it out. But things to keep in mind about is that this is what's very, very important that I think a lot of people forget. You can use up to $3,000 after you fully reduce your gains with your losses and you have a net loss. You can use up to $3,000 to reduce your other taxable income. So, for example, if you made $50,000 this year on stock A, and then stock B, you lost, $55,000, you can offset all your gains with those losses, and you would actually be in a net loss of $5,000. Of that $5,000, you can use $3,000 this year to also reduce your taxable income further, which to me is actually very, very nice because it could actually push you into a lower tax bracket potentially, so you pay less in taxes as a result. And then we're going to say, well, Fridge, why would I take all those losses, made all those gains there? And again, everybody has their own opinion about what's buying and when you should sell a stock. Some people would sell that and then they would take that money to put it somewhere else to hopefully make a rebound play maybe or something like that. So, you can take your losses, however it is you want. Now, here's the very nice thing. So again, going back to that example, I'll give you another example of tax loss harvesting, they call it, in just a minute here. But again, you made $50,000 on stock A, you lost $55,000 on stock B, you have a net loss of $5,000. $3,000 can be used to offset your taxable income for this year, and then the remaining $2,000 can be carried over into the next year. So your losses can carry over and stay with you over the years. And it can help to reduce your income tax bracket and stuff like that as you keep going further and further and further. So if you lost $30,000 this year, you can spread out that $30,000 net loss over 10 years to help reduce your taxes potentially in the future, which is very, very nice. Now, you cannot do it for retirement accounts because you don't generate capital gains loss in a retirement account. You can't use losses in IRAs or 401k plans to offset gains from other income. So keep that in mind. Now, breaking down this idea of tax loss harvesting here. Investopedia does a really good job of breaking it down here. Basically, again, it's selling securities at a loss, which is like, option, which is like stocks, ETFs, that kind of stuff, to offset your capital gains tax owed from selling profitable assets. This strategy is commonly used to limit short-term capital gains, commonly taxed at a higher rate than longer-term capital gains, to preserve the value of the investor's portfolio while reducing taxes. Tax loss harvesting is what you're looking at here. So that's a very, very important thing we talk about here, and something to really take a look at in terms of this. There's one thing to keep in mind about if you are going to be looking at doing tax loss harvesting, which you might hear a lot of people saying they're going to do tax loss harvesting around the month of December. People are taking the profits or taking the losses for taxes to get ready for the next year. So you might hear that lingo be used, especially around December, towards the end of December for that reason. So keep that in mind. One thing that's very, very important is that if you have to wait 30 days to buy the same stock you sold at a loss for tax purposes. It's called the wash sale rule. So wash sale involves the sale of one security and within 30 days purchasing a substantially identical stock or security. If a transaction is considered a wash sale, it cannot be used to offset capital gains. So you can do it, but you cannot use the losses to offset your capital gains in your taxes, which is important to know. So if you want to sell your Tesla position for a loss and you buy it back next week, you can do it, but you cannot use those losses that you realized to offset your capital gains. Very, very important to know. You can still do it. And if wash sale rules are abused, regulators can impose fines or restrict your trading as a result. Using ETFs that track the same or similar indices or indexes can be used to replace one another while avoiding violating the wash sale rule and tax loss harvesting strategy. If you sell one S&P 500 index ETF at a loss, you can buy a different one to harvest the capital loss, which is very, very nice. So for example, say you want to buy SPY versus VOO. If you sell your SPY for a loss, then you buy VOO with the losses. You still maximize it because you're still able to get those losses on one ETF. Then you buy a different ETF, same kind of idea, but you buy a different ETF name. They cannot hit you like that as a result of it. You are able to do that. So very, very important. So again, if you sell one S&P for a loss ETF, you can buy a different one to harvest the capital loss. Very, very important to know. Now, here's an example of just something to kind of keep in mind about. And again, everybody's examples are different here, but this kind of just gives you the idea as to the benefit of it, right? Because again, for me, I just see what is the purpose of me doing all the math here? Why would I want to do this? So assume a single investor earns an income of $580,000 in 2024. The investor's marginal income tax is 37%. And it's to the highest long-term capital gains tax category where gains are taxed at 20%. And again, if you take a look back up here, that's what they're talking about here. Hey, you make over this much money, you're taxed long-term 20% and short-term you are taxed at, 37%. Actually, this is 2024, 580. They should be at the 35-ish range here, looks like. But, it's okay. It's just an example. It's just an example, guys. It's just an example. It's fine. Again, talk to your own CPA or talk to TurboTax, whoever, just to give you an idea of what happens here. So say their portfolio, they have mutual fund A with 250,000 unrealized gains here, held for these certain periods. They have 3 different mutual funds here, one with gains, one with losses. These are held for over a year. As you will see, this one's held for under a year. And now let's say that they had some trading activity where they had 2 other mutual funds here, where they had a realized gain of 200,000 that was over a year long. And then they had another one of making 150,000, but was held for less than a year. So profits for longer than a year, losses for longer than a year, losses for less than a year here, profits for longer than a year, profits for less than a year. So if you were to pay taxes, your taxes would be looking at 200,000 on the long-term capital gains here at 20%, which we would see here, right? So here's your long-term capital gains, 20% here. So you would pay 20% of the $200,000 for the long term, plus 37% of the ordinary income for the short-term capital gains here, which means that he'll be paying $95,500 in taxes. It's like, whoa, that tax bill is insane. But let's say that he says, okay, so this is what I would be paying $95,500 right now in taxes right now without harvesting any losses. Now, let's say that he does that by harvesting, by selling off these shorter term or these losses here, one longer term and one short term, and what's going to happen to his tax bill as a result. So if he harvests by using these two to offset his gains with his losses, again, one is long term, one is short term here, $200,000 is his profit for long term minus the $130 from this long term means he would only be paying $70,000 in profits at 20%, which is $14,000. He does the same thing for the shorter term one. So again, he made 150 short term, but then he's going to realize his losses for this short term here, which is 100,000. These offset the gains. So he's only made $50,000 here at 37%, which is 18.5. His tax bill goes from $95,000 to $32,500. And that's a huge difference. Now, what does it do? Again, it allows you to offset your capital gains and everything else. And again, you can only use $3,000 of net losses if you need to. And again, why would you do this? It all bases off of your investment preference and what your, financial situation looks like, right? Because for me, if I made $1,000 in gains this year, I'll pay the 10%. It's $100. That's no big deal for me. I'll hold my losses and hope for a rebound, maybe. For example, if I'm bullish on a company long term, if I had a little bit of a downtime, then sure. The harvesting really benefits a lot of people when you have a lot of money being used up here. Because let's say that you don't have access, so that you don't have the funds right now. You're waiting for a deal to close in your company. You don't have $95,500 yet. But you do have, say, $50,000, you can then harvest your losses to then be able to pay your tax bill still. Because you don't pay your tax bill, then you go into a payment plan and they can garnish your wages and all these different things that can happen here. But things to kind of keep in mind about, again, the basics to look at here. And again, I'm not a financial advisor. I'm not a CPA or anything like that. Just some major important topics to keep in mind about. You have long-term capital gains. You have short-term capital gains taxes you got to make sure you file on for your investments. And you could also reduce your taxes by doing what's called tax loss harvesting. Okay, so keep that in mind as you're going to for your taxes. Again, this is just a very basic intro level of taxes. There's a lot more things you could talk about, but again, that is not something to cover right now. Just to kind of give you a little bit of an idea. Maybe you started investing last week or started investing, this year, and you were coming up at the end of the year, and you're like, wow, I've made $2,000 this year. Please keep in mind to have money aside for your taxes for next year if you have realized gains for it, okay? Again, if you haven't sold any positions, you don't have to pay taxes because those are unrealized. Realized means you sell them. Unrealized means you have not sold them and you're still holding the shares, okay? So thank you guys so much for watching today's video. Again, if you made this far in the video, make sure you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. As always, I hope you're making more in the market in some way, shape, or form, or maybe you're offsetting your tax a little bit here by doing some tax loss harvesting. And as always, I will catch you guys in the next video.